Welcome to Have You Read It? The channel where we bring books to life, one summary at a time. Today we're diving into William Green's Richer, Wiser, Happier: How the World's Greatest Investors Win in Markets and Life. This book explores the principles, habits, and mindsets of legendary investors, offering insights that extend far beyond the financial realm. Through engaging stories and direct wisdom from financial outliers, Green provides a practical guide to improving our thinking and decision-making. Richer, Wiser, Happier is unique because it combines financial advice with broader life lessons, emphasizing the importance of intellectual rigor, emotional balance, and ethical behavior. Green doesn't just tell you how to invest. He shows you how to think like the world's best investors, making it a valuable resource for anyone seeking success in any field. William Green, despite not having a background in business or economics, developed a passion for investing and sought to understand the principles that enable a minority of investors to achieve long-term market-beating returns. Green interviewed numerous investment legends such as Sir John Templeton, Faye Seraphim, and Peter Lynch, exploring their principles, processes, and habits. These investors emphasized the importance of not getting carried away, avoiding excessive risk, keeping costs low, and recognizing the crowd's fallibility. Green learned that the greatest investors are intellectual mavericks who question conventional wisdom and profit from others' mistakes, improving their thinking and decision-making in the process. The true titans of the investment world can teach valuable lessons applicable to personal and professional life by optimizing the odds of success through generalized rationality. Monish Pabray, an accomplished investor, utilized a cloning strategy, replicating the methods of Warren Buffett and Charlie Munger to achieve significant returns. Pabray's Dekshana Foundation provides free schooling to underprivileged children in India, reflecting his commitment to giving back and uplifting society. Pabray's father's entrepreneurial spirit, despite facing multiple bankruptcies, taught him resilience and optimism, lessons that shaped his approach to risk. Inspired by Peter Lynch's book and Warren Buffett's success, Pabray embarked on a 30-year game to turn $1 million into $1 billion, driven by a desire to win fairly and ethically. Pabray emphasized the importance of learning from others' successes rather than reinventing the wheel, advocating for the adoption of smart ideas from various fields. Pabray highlighted Buffett's core concepts of investing, viewing stocks as parts of businesses, understanding market irrationality, and buying stocks at a significant discount to their intrinsic value. Pabray stressed the need for extreme patience, selectivity, and concentration in investing, waiting for rare opportunities to make mispriced bets with minimal downside and significant upside. Drawing from Buffett, Pabray filters potential investments by staying within his circle of competence, ensuring a sufficient margin of safety, and seeking companies with durable competitive advantages and honest management. Pabray attributes his success to shameless cloning, checking his ego, and prioritizing what works over originality, underscoring the importance of truthfulness and generosity. During a charity auction, Pabray teamed up with Guy Spare to win a lunch with Buffett to show gratitude to their guru. Pabray was taught by Buffett, at a power lunch, the importance of patience over leverage, and the morality of living by one's own standards and principles rather than external validation. Pabray views Dekshana as a means of uplifting the most underprivileged segments of Indian society, especially focusing on educating girls from impoverished backgrounds. The author of this book highlights Pabray's journey as an inspiration for thinking about the power of cloning and how to use it to enrich their lives. Successful investors possess the willingness to be lonely, taking positions that others deem unwise, driven by inner conviction and an ability to think independently. Sir John Templeton, an unconventional investor, demonstrated his greatness through his fitness regimen and indifference to others' opinions, providing insight into his success. The best investors are not like other people. They are iconoclasts and mavericks who see the world differently and follow their own path, both in investing and in life. Great investors often display low emotional intelligence, preferring individual sports and solitary work environments that support their heroically inactive investment strategies. To beat the market, investors must diverge from the market and dare to follow unorthodox practices like waiting for fat salmon, maintaining extreme patience, saying no to almost everything, and exploiting the market's mood swings. As an investor, it is best to beware of your own ignorance and seek diversification as a means of protection. Also, beware of emotions to prevent rash decision-making. Templeton achieved extraordinary returns by purchasing reviled stocks during World War II, demonstrating the value of buying when others are desperately selling. Templeton advised against chasing fads and highlighted the importance of focusing on value by examining valuation measures and distancing oneself from market predictions. Templeton capitalized on the dot-com bubble burst by shorting overvalued internet stocks when lock-up periods expired, showcasing his ingenious ability to profit from investment insanity. John Templeton's self-reliance and self-confidence helped him to pursue an agenda that was in alignment with his own personality, principles, and preferences. Howard Marks emphasizes the inevitability of change and the importance of accommodating to the environment in investing in life. Marks, who was an unemotional individual, made rational decisions based on facts and figures, probabilities, and trade-offs between risk and reward in order to become successful. He was a student of Japanese literature, art, and civilization, and his encounters with the Zen concept of mujo, or impermanence, helped shape his philosophy of investing. To make smart decisions about the future, Marks advises people to be humble, note their limitations, acknowledge their luck, and avoid efficient markets. Marks states that everything, including nature, economies, markets, industries, and even our own lives, is always changing, so we must accommodate it, as change is constant. The market changes, but Marks reminds people that hope is not a method. He also encourages other people to avoid common mistakes such as paying lavish fees, and to buy and hold index funds. For Mark, it's all about simplicity. It's better to use an investment opportunity that is not hard to understand. The keys to success are recognizing your own limits and vulnerabilities, as well as being honest with yourself. He also recommends that the secret is to not think you're the master of the universe. Marks also mentions that key to the challenge of the game is that the investor lives by an attitude of generalized rationality and is not an emotional mode. As an investor, the best way to handle situations is to analyze where everything stands in its cycle. The main point being that everything changes and nothing lasts. Jean-Marie Evillard, a renowned value investor, emphasizes minimizing risk due to the uncertain future and advocates for a margin of safety. Evillard learned from Graham that the important thing about investing is not to get excited, but to look for things that are undervalued. As an investor, consider buying undervalued assets and make an effort to study the stock market to understand how these things work and how to keep your emotions at bay. Investors such as Munger understand that it's about keeping your mind strong and trying to reach a common goal. Evillard stressed that the biggest challenge for an investor is finding a method that allows you to see reality as it is and distance oneself from the market emotionally. For financial security in the market, it's important to have low standards for yourself in some parts of your life, and to remember that it's impossible to be perfect. Also remember to not depend on the kindness of strangers. Because everyone's situation will be different, be sure to remember that long-term performance is what counts in becoming successful, and take lessons from these investors to increase your success. It is a valuable skill to study how other well-known investors are making their money, such as with Buffett and Munger's wealth that has to be studied for yourself to get the whole picture. Graham and McLennan constructed a lifestyle that distanced themselves emotionally from the market. When it comes to managing time, remember that you cannot force the issue and must be patient. To be a strong investor, it is important to be in one's self and mind, to consider emotions when making choices. and never get in the way of the ultimate goal by focusing on external validation. Joel Greenblatt emphasizes the value of simplicity and the potential pitfalls of complexity in investing. Greenblatt states that the most successful investors focus on buying good businesses at bargain prices, which can often lead to the best long-term returns. When looking at stocks, Greenblatt mentions that a cheap asset should trade well below its underlying value and that an investor should study how the market reacts to these opportunities. Greenblatt's long-short strategy is designed to reduce risk and provide a less painful ride. That is, that long-term success requires being a good player, not being caught up with the day-to-day. Will Denoff, manager of Fidelity's Contrafund, believes that stocks follow earnings and focuses on businesses with sustained, above-average growth. The book notes a test that looks at both a company's finances, capital, tangible assets, as well as any outside influences, public relations, psychological biases. The book references Munger by name, detailing the focus to which the speaker focused most of their attention when talking about Munger in the past. The central focus of Kay Zakaria and Nick Sleep's approach to investing is to value that every single action in life is a moment in time, to increase satisfaction and to build towards perfection. Zakaria and Sleep reject sales and marketing strategies instead. They apply focus to the market on those rare but big winning investments, such as with stock investing at AirAsia and Amazon. At Amazon, there is a powerful business model used by founders and people in high management, one where they can see the true potential in what is possible, which allows them to act on it. Investors need to be prepared for how best to focus on the long-term gains, not the instant gains. Be patient and put aside the need for the external and focus inward. Tom Gaynor emphasizes the importance of continuous improvement, disciplined execution, and emotional balance for achieving sustainable investment success. Investors are encouraged to adopt sustainable habits and processes over extreme actions. It can help to reduce or make small the losses. Investors must also commit to continuous learning by reading, studying other professionals, and continuously finding people to offer new ideas. The world is always evolving. That with extreme thought, it's good to focus on ethical decisions. Be kind. Always do good. Don't abuse your influence or talent. That every little thing helps. That you can have the greatest influence and affect change that has a great compounding effect. But to also remember to be persistent and dependable in your field. Munger highlights the need to avoid self-defeating emotions and cultivate rational thinking. Charlie Munger advises focusing on what to avoid instead of what to do in order to make smart decisions. A habit that's also followed by Tom Gaynor of the Markle Corporation. As an investor, have the humility to learn from mistakes and try to not take the path with great risks, because sometimes a simple answer is the greatest of all. The mind often plays tricks on the investor, and the best thing to do to help is to remember what Munger preaches. You have to avoid those temptations and take breaks. There are different levels of the best investors, but all share the one indispensable trait of being resilient, with clear minds. All problems can be reduced and solved to their smallest version by staying calm with his money. Munger sets aside a generous amount to focus on better things, and he recommends this path to keep stress at bay. All the best investors have extreme clarity and are not affected by their emotions, thus helping to see more clearly. Remember that whatever strategy is used in investing, it needs consistent application, especially when it gets difficult, because then you can also prevent self-inflicted chaos. Also, remember to build strong teams, because by focusing on what you're good at, you allow others to flourish as well, which builds a healthy team of people working to one common goal. What you accumulate doesn't make you who you are as much as what you give up to have that. Prosperity. Focus on helping others to live a happy and prosperous life. It's not enough to be set financially. Emotional and spiritual fortitude are needed in order to build a full life of gratitude that will be remembered by peers, friends, and family. People like Thorpe and Parbre value their actions and try to see the world in a positive state. And they work to better themselves instead of those who are not as fortunate as they are. Here are some of the most important lessons from Richer, Wiser, Happier. Clone intelligently. Don't reinvent the wheel. Instead, identify and replicate the best practices of successful individuals. Embrace loneliness. Be willing to think independently and defy conventional wisdom. Seek simplicity. Cut through the noise and focus on the essential principles that drive success. Control your emotions. Avoid impulsive decisions driven by fear or greed. Prioritize continuous learning. Stay curious and keep expanding your knowledge base. Practice patience. Good things take time, and the best investments often require long-term commitment. Always consider the odds. In both investing and life, strive to stack the odds in your favor. Mitigate risk. Protect yourself from potential disasters by maintaining a margin of safety. These takeaways aren't just about making money, they're about living a more thoughtful, deliberate, and fulfilling life. In closing, Richer, Wiser, Happier is more than just a guide to investing. It's a life manual providing strategies and insights that enhance decision-making, promote rational thinking, and encourage personal growth. William Green challenges us to look beyond conventional wisdom, teaching us how to optimize our odds of success in both markets and life. Ultimately, the journey through this book may not just make you richer, but certainly wiser and happier. Consider picking up the book to explore these ideas further. Thanks for watching. Make sure to give this video a thumbs up and hit that subscribe button so you never miss our next book dive.